The Yogi Economist presents Home Loan.
Supandi wants to buy his first home. But, without a home loan it is not possible. The confused bank manager confuses Supandi by using so many terminologies. In this video, we will help Supandi by explaining EMI, followed by loan tenure, interest rates, and penalty. EMI is equated monthly installments. This is the monthly amount paid by you to the lender until the loan is fully paid. EMI depends on the loan tenure and the interest rates. EMI consists of interest on loan and the principal amounts. The interest component of EMI is larger towards initial months, and principal component is larger towards the final months of the loan. Loan tenure is also called as loan term, or loan period. Loan tenure is the time taken to pay the entire loan. The maximum allowed loan tenure is either 30 years, or, when the borrower attains age 70, longer loan period will have smaller EMI payment. Shorter loan period will have a higher EMI payment. Longer loan period has smaller EMI payments. But, the interest paid for the entire period will be higher. This might slow your retirement plans. A shorter loan period will save lots of money towards the total interest. But, the EMI payments will be higher. You might end up living cash tight. This table summarizes the advantages and limitations of both longer and shorter loan tenures. Late retirement or living cash tight is your option. It is prudent to take longer loan period when signing the loan papers. And, pay off the loan whenever you can. This will get you loan-free sooner without paying high interests. Interest rate can cause a good investment to become a bad investment. Two types of interest rates are available for home loans: fixed rate and floating rate. Let's say if you get a loan for 10 years at a fixed interest rate of 10%, fixed interest should stay the same for 10 years, but some banks might add a reset clause. A reset clause might reset the interest rate every 3 or 5 year period, and interest rate might go up or down when reset. Usually fixed rates are 1 to 2% higher than variable rates, as the banks parcel the risk of a higher inflation and pass on to the customer. You might pay up to 5% of your home value in interest rates, if you chose fixed interest for a long period of time. Now let's understand how floating interest varies from a fixed interest rate. Floating rate is a variable rate. It is the sum of bank base rate and the spread. Banks review their base rates every quarter, and change if necessary. As the floating rate is a variable rate, it is prone to change throughout the loan tenure. When the base rate changes, interest rate varies. When the economy is good, the interest rate increases. During economic downturn, the interest rate usually goes down. Typically floating rate are risk-free to banks, and usually lower than fixed rates. On the long term, floating rate saves money compared to fixed rate. Understanding mortgage term is very critical to get a good interest rate. Loan is a contract with your bank. This means many terms and conditions might be applied in fine prints. Prepayment penalty is one of them and usually applies to fixed interest. Prepayment penalties might obstruct you from closing your loan sooner than the loan tenure. Ask questions to your banker regarding all types of penalties. Clarify if you can switch your loan with another lender and the penalties applicable. Clarify if you can change your interest rates if they go down without paying penalty. Save yourself from hefty penalties by doing thorough research.